So thinking about this kind of catastrophic, well, the situation that potentially become catastrophic, is this related to, I know you follow geopolitics, is this related to the kind of de-dollarization, this move away from the dollar, the global reserve currency that we're seeing from the likes of China and Russia? And I know there's some Ukraine war stuff that can probably be thrown into that as well anyway. But is this just basically smarter people in the room who need to understand this at the sovereign level within these nations who've realized what's happening, and that's why they're exiting the dollar?
Yeah, for the de-dollarization of commodities is largely defensive in nature. It is an existential threat to them to get away from the dollar monopoly in commodities. And the reason we say that can be laid out most easily. Kyle Bass gave an interview, I don't know, about 4 years ago, which he said, listen, the Chinese, they're buying more and more oil. They're importing more and more oil. They're consuming more and more oil every year. And that oil is only priced in dollars. And so as oil gets more expensive and they consume more of it, they're going to need to have more dollars every year just to keep their economy going, or else all the debt they have, their economy will implode, the debt will implode, you'll have a huge crisis. And Kyle went on to say, but they only have a finite number of dollar reserves. And so as oil rises and their consumption rises, and at some point they're going to run out of dollar reserves, and then they're going to have a 1997 Southeast Asia crisis where they run out of reserves to buy oil, and either they have to shrink their economy and they have an economic crisis, or they devalue the yuan, or whatever, then you have inflation, it's crisis. So ultimately, for China in particular, on one side of it and some others, it is a matter of national security for them to gain the ability to import their energy, at least partially, in their own currency. And they have done that. They've done that with Russia. They've done it with Venezuela. They've done it with a number of other nations. That, if you look at, this was back in 2018 data, and that's the IIF's data. If China had bought all of their commodities in yuan in 2018, their trade surplus in dollars would have risen by $800 billion, right? So they'd be $800 billion they wouldn't have had to have put out in commodities because they were printing up yuan. Now, there's a recycling issue. We've highlighted a number of times that we think they're recycling it into gold and goods and gold. But the point here is that 800 billion is probably $1 trillion or $1.5 trillion now, given more volumes they're importing in commodities and higher prices. So China cannot have the dollar crisis that a lot of yuan bears are saying if they just start moving some of their oil import bill, their commodity import bill, into yuan. Every, if it's $1 trillion, $1.5 trillion in aggregate, every 10% that they shift their commodity bill out of dollars into yuan increases their annual dollar liquidity every year permanently by $100 to $150 billion. They're not going to run out of dollars. And so if they're not going to run out of dollars, that means they're not going to have those crises. And the flip side of that means they don't need to buy as many treasuries. It means the intensity of their FX reserves per dollars goes down. So in 2013, China's FX reserves as a percent of China's GDP was 46%. By 2018, that number was 26%. That number is now 18%. And it's going lower because, again, they can buy marginal tonnage of commodities in yuan, not dollars. That turns around and puts pressure on the U.S. in terms of just the treasury market of foreigners don't need to buy as much. On the flip side of that same coin, Russia, Putin said this in June of last year in a speech that was, of course, ignored across most of the U.S. He highlighted that the U.S. has the real rate on treasury debt -8%. And where do you get that number? If you look back from 2008 to present, U.S. Treasury issuance has rose by 8% per year, has risen 8% CAGR. The yield on the 10-year Treasury has barely ever been above 3. So basically, I would love that deal. If you guys want to give me that deal, let me know. I will issue you 8% more IOUs every year, and I'll pay you 3%. And I'll use part of the 8% more that I borrow every single year from you to pay you back yours. And then it's a Ponzi scheme. And he has finite oil. Like, he has finite oil production. We don't know what that number is, but it's finite. We heard that when people said, well, if he doesn't reinvest, oil production is going to fall. Exactly. He has finite oil production at some level. He cannot afford to stockpile his wealth in a reserve asset like treasuries where the supply rises 8 and the coupon's 3. He would have to be an idiot, and he's a lot of things, but an idiot isn't one of them. So he started buying gold as his primary reserve asset 10 years ago, 15 years ago. Some of that was in response, post-13, in response to the original sanctions, etc. But the point stands, which is both of this de-dollarization dynamic from both sides of this coin are really the sovereign version of what we let off talking about, which is peak cheap oil, peak cheap energy, and global sovereign debt crisis. They are addressing this by shifting to multi-currency energy pricing, settling in goods, and then settling net deficits in physical gold, whose price floats in all currencies. Now, could Bitcoin be that reserve asset at some point down the road? Yes, it could. Is it there yet? In my opinion, no, because you've got this status quo system, and if there's going to be a transition in the system, it's probably going to go through gold first, which requires a much higher price of gold. That's a separate discussion. But yeah, this whole de-dollarization thing is ultimately all about sovereigns making a decision in their own enlightened self-interest. It's basically a matter of acute national security that they get away from pricing their commodities, because otherwise their commodity bills go up 100, 200%, and they have the same problem, except in those places people don't sort of, the political outcomes are more extreme, shall we say.
And so obviously this movement away from the dollar being a global reserve currency is going to exacerbate issues for the US for their own currency. But is there an argument that this is net good for the world because it takes the pressure of other nations with a rising value of the dollar, makes all imports a lot more expensive, especially for smaller countries? We've made shows discussing this, when the US, for example, during COVID printed stimulus checks, none of those reached people in El Salvador, who are a dollarized nation. But you don't even have to be a dollarized nation. With everything priced in dollars, it makes it difficult for other countries. So can you make an argument that a de-dollarization, yes, bad for the US, but good for the world?
I would even go a further. It's good for the world, right? When we talk about all the debt is owed in dollars, if you want to stimulate growth, the easiest way to do it is reduce the debt burden, right? Give the world a debt break. How do you give the world a debt break? You reduce the value of the dollar, right? So the dollar falls, the debt burden of the world falls. I would go one further and say it's good for the U.S. If you look at it's just not good for the part of the U.S. that has won the last 20 years, the last 30 years. Who's won the last 20, 30 years in the U.S.? It hasn't been the U.S. It's been China. It's been Wall Street. And it's been Washington, D.C., certain interests in Washington, D.C. Those have been the winners in the U.S. Everyone else is lost on a net basis. Like, we're all just, it's Washington's world. And there's 7 of the 10 wealthiest counties in America are around Washington, D.C. What does Washington, D.C. export to make all that money? Simple. Treasuries. They export dollars. They don't make anything. So if you look at the winners in the U.S. over the last 20, 25 years in particular, you can make the case, even stretch out the last 35, 40 years, the weaker dollar and the loss of treasuries. I think the dollar is going to stay the reserve currency, but I think we are 10 years into the treasury bond losing its status as the primary reserve asset to gold. De facto, we can see it in the data. Central banks have bought $300 billion in gold. They've sold $400 billion in treasuries in the last 8 years. That switch is already well underway. It accelerated meaningfully last year. That is a world where if gold at a floating rate is the neutral reserve asset again, then suddenly currencies will trade on a balance of payments basis around gold, right? Basically, if you are net settling in gold, then you're going to run deficits like the U.S. and the U.S. and UK run the biggest deficits, U.S. first, UK second. Your currencies are going to fall sharply against gold. And at the same time, China, who has been sort of manipulating this dollar system in a mercantile way, they're running this big surplus. Their currency is going to strengthen meaningfully through the gold link, right? So the price of gold will fall in China because gold's going to flow in that direction. Gold falls in China. Yuan rises against the dollar. China suddenly has to consume more of their own production. They've been talking about becoming more consumption-oriented forever. Well, to become more consumption-oriented, you have to be able to print your currency for energy, check. And then you just need your currency to strengthen relative to your imports, check. Same side here is if we need a rebalancing in America, what does it take? Set up a neutral reserve asset. The dollar needs to fall dramatically. That's going to increase inflation in the U.S. dramatically, but it's going to increase production at the expense of consumption. And it's going to rebalance the economy away from Washington and Wall Street towards more productive enterprises. And at the same time, that falling dollar, remember, like we just said, it reduces the debt burden globally. So there's going to be more global demand as the global dollar debt burden falls. So like literally the falling dollar is great for everybody except for certain Washington interests, certain Wall Street interests, and certain Chinese interests. So I think we're moving in that direction because people say, well, we couldn't afford the wars. We couldn't afford the military. Well, yeah, not at $850 billion a year. But like if you talk to most U.S. military officers on down, for 10 years, they've been telling you this is unsustainable. We need to get out of this. You know, we need to reinvest into more productive enterprises such as infrastructure, education, et cetera. So I would argue a much weaker dollar and the process that is already underway by a much weaker dollar by moving from treasuries being our primary reserve asset to gold at a floating rate and all currencies being our reserve asset, is really good for the USA. It's just not really good for, the USA that are whispering into the anchors' ears at CNN and, MSNBC and Fox and what have you.